So what we've done differently in our markets is actually oracle-driven markets, where we query a range of different oracles so that we can actually, for our markets that instead of AMM, we call FPMM, fixed price market makers, we can query a wide range of oracles about the FX rate and then allow users to swap directly at this FX rate. These fixed price market makers on Mento is what we in the end call distribution pools. So you can easily access then these 15 currencies. What we also need to supply then the stable coins in these FPMMs are what we call expansion pools, markets where these stable coins are minted into existence. In today's setup of Mento, we have a single reserve over collateralizing all the stable coins that are outstanding. The reserve is fully on chain so that everyone can verify that this reserve exists. And against this reserve, you then can mint stable coins into existence. But in a future version of Mento v3, we also offer CDPs where users then actually can borrow local currency into existence.
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization in the blockchain revolution. I'm Friederike Ernst, and today I'm speaking with Markus Franke, who is the CEO of Mento Labs, an on-chain FX and stables issuance protocol that started originally on top of Celo. Before I talk with Markus, let me tell you about our sponsors this week.
Hey guys, I want to tell you about Gnosis, a collective of builders creating real tools for real people on the open internet. Gnosis has been around since 2015. In fact, it started as one of Ethereum's very first projects. And today it's grown into a whole ecosystem designed to make open finance actually work for everyday people. At the center of it all is Gnosis Chain. It's a low-cost, highly decentralized layer 1 that's compatible with Ethereum and secured by over 300,000 validators. So whether you're building a dApp, experimenting with DeFi, or working on autonomous agents, Gnosis Chain gives you a solid, neutral foundation to build on. But Gnosis is more than just infrastructure. It's also tools that people can actually use. Like Circles, for example, lets anyone issue their own digital currency through networks of trust, not banks. And then there's Metri. It's their smart contract wallet that makes it easy to access Circles, manage group currencies, and even spend anywhere Visa is accepted, thanks to their integration with Gnosis Pay. All this is governed by Gnosis DAO, where anyone can propose, vote, and help guide the network. And if you want to get involved, running a validator is super easy. All you need is one GNO and some basic hardware. To learn more and start building on the open internet, head to gnosis.io. Gnosis, building the open internet one block at a time.
Markus, it's a pleasure to have you on.
Friederike, thank you so much. Great to see you. Thank you for having me.
Cool. Markus, you actually have a pretty eclectic background. We often see these founders who kind of start something kind of like while they're still at school or university, and then kind of like, but you have had an entire first life. Tell us about that.
That is true. I'm already a bit older, already have like first wrinkles around my eyes. That is also maybe due to this industry. So yes, I'm coming from an economics background, did a PhD in economics, worked in research for some time as a postdoc researcher at the University in Munich, in Hong Kong, in New York, and then worked in the traditional finance industry, TradFi, as I would say today. Worked for different investment banks, Merrill Lynch and JP Morgan, and then also worked as a portfolio manager for Allianz Global Investors inside the Allianz Asset Management Group. And there I worked on managing pension fund portfolios, different asset classes, everything from currencies to equity to bonds. Often worked more on the risk and research side of things. And then around 8 years ago, joined Web3 ecosystem, went down the rabbit hole. Back then, I actually was managing a part of a pension fund from Bank for International Settlements. They told me, oh no, you're also going to this industry. Do not touch these assets. This is evil. In between back then and now, they changed their stance a bit on Web3, but they're still relatively skeptic on what we are doing. And then actually started in the Celo ecosystem, was part of the initial team. As an economist, always worked on stablecoins. And then 3 years ago, we spun out Mento from the core Celo or C Labs team as a standalone project.
There's a lot to unpack here. Maybe let's go a little bit back. So you said that you kind of joined the Web3 ecosystem 8 years ago. What was it that drew you in? Because kind of like you came from a fairly traditional conservative finance background, right? And kind of like, I mean, the gap is still there, but back then it was immeasurably wider than it is now.
Absolutely. And I think back then, the narrative why I joined Web3 was still, I would say, relatively new. Today, every ecosystem took this narrative of financial inclusion, giving people access in countries where they don't have proper access to financial primitives via Web3. These types of narratives in the past 8 years, we have heard them a lot from everyone from Libra to Celo to like all the ecosystems out there. But still, I think this is one of the most important things we still have to solve. We didn't go to the billions of people yet that use Web3 every day. And therefore, back then, this was what drew me to this industry, that maybe there's a new technology that can allow people to easier access financial primitives. Maybe this would solve many different problems in many different countries where maybe the financial infrastructure is not as advanced as in Germany, if you can call that advanced, or in other countries of the world. And maybe this technology has the promise, or can actually solve many of these problems that are closely linked to deeper economic problems of different countries, how people can exchange value, how people can have ownership over certain assets. And I think these problems are still there today, and therefore we still have to continue to work on those.
I was recently joking with a friend that initially kind of our drive was to bank the unbanked, but
Yes.
kind of we ended up unbanking the banked. How do you think this happened? Where do you think we went wrong?
This is actually a very, very good way of phrasing it. I think this is very, very true. And I think it gets like, or it becomes even more true when we now see the new projects that enter the space, that build all their own L1 or L2, and try to do the same in the end, unbanking the banked, or maybe even banking the banked, but using different type of technology stack. I think what went wrong was probably a bit lack of focus of the industry, what we're trying to solve for. As always with new technologies, speculation, hype, markets, pose different challenges for builders to stay focused on solving these problems. I think especially the DeFi summers and now maybe people already talked about a stablecoin summer, and all of these different things led to a lot of speculation. And the price action in many different assets in this field made some people poor, some people rich, but we didn't focus on actually solving that problem. So maybe greed was the problem, why we weren't focused. Maybe now it's the time that this industry focuses again on solving the problems that we want to solve in the first place.
Yeah, I couldn't agree more. So kind of you have this entire background in economics, and kind of in crypto, everyone is an economics expert, right? So kind of like how does your experience in academia and kind of TradFi institutions shape how you think about money in financial systems, and how is that different from how you see kind of the ecosystem average kind of thing?
It's a good question. And I think actually coming from an academic background, in the end, I don't know if that helped in this industry. I hope that it helped. I think where sometimes maybe it didn't help was actually that we approach many things much more conservative. When you're building, especially in our case, building stablecoin platform, building for on-chain FX solutions, building also with users in mind that are in countries where their livelihood depends on this technology to work, then you do this in a much more conservative way. Building these things in a much more conservative way could also then sometimes mean growing slower than many other projects that shoot up. I think in the stablecoin space, everyone knows about the stablecoins that didn't build very conservatively and then at some point also went under. But even those who are still around, there's a lot of questions that economists, I think, would have question marks when it comes to counterparty risk, when it comes to efficient pricing of a stablecoin depending on the underlying collateral, when it comes to, for example, so-called fiat-backed stablecoins that are actually backed by credit, money in a bank or money in a securities account, when it comes to questions around counterparty risk, when it comes to questions around what is the true price of that collateral, if there is counterparty risk, if there is credit risk, and so on. I think all of these questions didn't really matter in the past 8 years, when also the question of how volatile currencies actually are didn't matter in the past 8 years. Both of us are spending a lot of time in Europe against the euro. The dollar this year alone lost 20% in value. So maybe there is a place for other stablecoins than just dollar-based stablecoins. But in the past, all of this just didn't matter in the industry because A, other crypto assets were much more volatile than currencies, and B, growth was often much more important than things like counterparty risk or proper collateral and so on. And I think this is maybe where we had always had a bit of a different approach. We are still around, which is good, but that also meant we grew much slower than many other projects in the space.
You guys spun out from Celo. So you were one of the founding team of Celo. And kind of tell us about this. I mean, we've had Celo on several times, both Mark and Rene, and I think the listeners are well aware that it's kind of like, it used to be this mobile first L1 that was kind of centered around the global south and payments, and kind of became an L2, or is in the process of becoming an L2. So I think kind of this is, but kind of what kind of drove you to kind of start a new kind of stables protocol kind of from that background?
Yeah, very, very good question. I think, as you mentioned, payments, financial inclusion, and with that, stablecoins always have been extremely important for Celo. Celo, as a now L2, is still focused a lot on stablecoin transactions. There are wallets with Valora and MiniPay on Celo live that since day one actually had the focus on emerging markets and on end users, retail users that want to send easy transactions. And some of the features that back then were very, very new on Celo, that you could abstract away all the difficulties around gas fees, for example, by paying gas fees in stablecoins, were important features for an ecosystem that was focused on retail, that was focused on stablecoins. I think in general, for the L1 and now L2, Celo, it is important to have many different stablecoins live, and not only Mento stablecoins, but also the market leaders, Tether, Circle. They are both alive on Celo, and I think it's important for the blockchain. At the same point, or at the same time, it's important for Mento to at some point launch its markets and go live on other ecosystems as well. So what we are currently really focused on, and where we can maybe also talk a bit more about later on, is that we are now actually rolling out our cross-chain strategy and want to launch Mento on many different ecosystems out there. So similar to my belief that we need to have many stablecoin providers or offers on Celo, at the same time, Mento should also sit on many different blockchains and platforms as well.
Maybe before we kind of dive into the architecture of Mento, kind of one final question to kind of set the stage. So stablecoins are obviously kind of a representation of something that kind of like we've had in the off-chain world, not going to say forever, but for a very long time, right? Do you see stablecoins more as a bridge to existing financial systems, or do you see them more as a foundation of a new one?
It's a good question. I think probably I need to think a bit more about that. I think having the opportunity to transact in stable value, whatever that means, is a foundation of or a foundation for on-chain transactions. And stable could mean stable to the underlying currency, like a stablecoin usually works. If I'm in Europe, a stablecoin should represent the euro, and therefore I can do transaction on chain also in euro when I have to pay for a service that is denominated in euro, or if I have to pay my taxes in euro, and so on. Stable could also mean stable to a basket of goods, like all these stablecoin projects that want to go in that direction, where stable means stablecoin should follow purchasing power basket of goods in a certain country, which is, I think, extremely interesting in countries where there's high inflation of the national currency. And I think these assets are extremely important. And stable could also just mean transacting in an asset that doesn't have that high inflation and as the local currency. So I think in some way for proper transactions, stablecoins in some way are a foundation, and then we still have to define stable to what. On the other hand, I think we are also just in the beginning of basically that field where we need to explore more what currencies actually can do. I think in the beginning, what we did here in the past 8 years basically is mimicking currencies as they already exist and just bringing them on chain. And there's already a lot of value in there. But you could imagine going forward, there's even more what we can explore, like certain use case currencies, new currencies for specific type of use cases for saving. Maybe for saving, you need a different type of currency than for transactions. In transactions, also back then in the Celo ecosystem, we've talked about demurrage in the past a lot, like setting certain incentives to people in a currency ecosystem to transact more as a means of monetary policy. So I think on the one hand, yes, stablecoins in some way are a foundation for me for this technology to work in the real world. On the other hand, I think it's also just a start, and from here we can actually experiment with currency much more and can come up with newer solutions to many problems.
Yeah, super cool. I will come back to that for sure. Before we do that, let's dive into how Mento works. So if you kind of look at Mento's design at a high level, can you describe what the main components are that make up the protocol?
Absolutely. So there's two main components in general. One main component are the stablecoins, and many of the stablecoins that today are live on Mento are actually also Mento stablecoins. But we also integrate more and more outside stablecoins as well. So for example, USDC and USDT are also integrated in Mento in the second component. The second component actually on Mento are new types of markets. And to explain a bit these new types of markets and why we came up with this, I have to talk just for a moment about FX as a primer, and about the FX markets and how they today exist also on chain. In general, FX markets globally are huge. The Bank for International Settlements estimates that the FX market globally is $7.5 trillion in daily volume. In the end, FX markets mean just the exchange for different currencies, basically one currency for the other. And then there are many different more specific types of FX markets. There are spot market, there are forward markets, there are like swaps, FX swaps, which is a combination of a spot and a forward transaction. And the spot market alone is $2 trillion a day in volume. So in general, we can say it's the largest market in the world, because every time when someone either wants to exchange currency or wants to do business cross-border, they might enter this FX market.
And tell us how this works, kind of like in the traditional world. So kind of like say, I'm Deutsche Bank now. So kind of I have probably accounts with various banks around the world in different currencies. So kind of like how do I go about settling trades from one currency to another? So what exactly is it that kind of sets the rate here?
Yeah, absolutely. And this is already where it becomes, in traditional world, really, really complicated, and actually also where the technology that is used is different between different countries, between different currency zones, but even like between different providers that actually allow you to access the FX market. Deutsche Bank is a good example because it's still one of like the top 10 currency traders in the world. There's JP Morgan, there's UBS, there's Citigroup, there's Deutsche Bank, there's HSBC, there's Goldman Sachs, there's many others, and they all in some way as banks engage in the FX market. However, then there's also many non-financial institutions that also engage in the FX market. There are many like broker dealers that allow customers to engage in the FX market. And in some way, when they engage in the FX market, there's always in some way some pre-trade moment when basically parties that want to engage in that FX market want to agree on a transaction. There's then the trade execution, there's the clearing, and there's the settlement. And all of this, when these traditional players basically engage in that FX market, typically takes around 2 days until an FX trade is settled. It takes even longer when there's a weekend in between. It doesn't work 24/7. And here we're already basically now describing many problems that actually could be solved with on-chain technology, because, this market doesn't work 24/7. This market doesn't settle immediately. And because it doesn't settle immediately, clearing and settlement are all prone to risk in some way. There's a settlement risk, there's a counterparty risk, there's of course also price risk that can be hedged away. There's a regulatory risk when you basically go between different countries. So the whole FX market is extremely complex. And it gets even more complex because it works on many different technology stacks globally. There's large settlement houses, including the exchange in Chicago and like many other settlement houses, Eurex and others that then help with the settlement of an exchange trade. And because it's such a wide range of parties that engage in the FX market, there's so many problems. The dollar is actually still the most traded currency, also in traditional FX. I think it's in around 80 to 85% of all FX transactions. The dollar is a part of that transaction. The largest FX market is between euro and dollar, and then there are all these other currencies like yen, pound, Australian dollar, Canadian dollar, Swiss franc, Hong Kong dollar, that basically in decreasing importance are also part of this FX market. And actually, that high percentage of the dollar in all FX transaction is another problem, actually. This is the reason, or the dollar is in such a high percentage of international FX transaction, because many markets don't have direct liquid pairs. So if you're, for example, in Kenya and you're doing business with Ghana, there's often not a direct Kenyan shilling to Ghanaian cedi FX market that you can access, not only because maybe you don't have access to a bank, but also because there's just no liquid interbanking FX market between Kenya and Ghana. So what you typically have to do is you have to exchange from Kenyan shilling to US dollar, and then from US dollar to a Ghanaian cedi. And I mentioned before, typically between pre-trade, trade, and then execution and settlement, there's a T+2 days window until a trade settles. If you then have to go from Kenyan shilling via the dollar to Ghanaian cedi, then it's already 4 days at least until your trade settles. So all of this makes the FX market extremely complex. And I'm convinced that a part of this market should move on chain, so that globally users can actually access this market on infrastructure that runs 24/7, that settles almost immediately, and where you can basically use the same infrastructure no matter between which countries and currencies you want to do business. And we are, with Mento, focusing on this FX market. I mentioned the first building block of Mento, which is stablecoins. Currently, there are 15 different currencies live on Mento, all the G7 currencies that I mentioned before. So the dollar, the euro, the yen, the pound, Swiss franc, Canadian dollar, and so on. But we also have a few more exotic currencies live, also the ones, for example, that I mentioned, the Kenyan shilling and the Ghanaian cedi. Yes.
I want to hear kind of like how these currencies kind of like are set up afresh and kind of and so on. But before we get into that, let's talk about the FX part first, just because we're in it already, right? So I see why you see potential for disruption here. So obviously, kind of like if you had an intent-based kind of settlement layer that was capable of kind of doing ring trades in an atomic fashion, obviously that would be vastly superior to kind of like waiting 2 days for any link of any leg of the trade, particularly because I'm sure you can't lock in kind of things for in 2 days from now, right? So kind of like if you go from A to B via C and you go from A to C first, and then kind of like the C to B leg disappears, kind of like you have to go back,
Yes.
try different. I mean, that sounds like a nightmare. So tell us about the FX system that you've built.
Absolutely. And actually so this is the way how Mento markets worked actually from day one. But now in our endeavor to go cross-chain, and when we talk to many other foundations outside of the Celo ecosystem, we actually recognize how important this is to have these types of FX markets actually on chain, because in many ecosystems on chain, this is potentially also the reason why there's not a huge adoption so far for non-dollar stablecoins, at least one of the reasons. And that reason in the end is that typically markets on chain are so-called AMMs, automated market makers, where the price finding actually happens on chain, and the price depends on the relationship of two assets that sit in such an AMM to each other. So, and this concept can be even more generalized. There can be like more assets combined in an AMM, but in general, there's two pools of assets, and the price depends on the quantities that sit in these two pools in this AMM. Now, the problem is that the price of euros in dollars is not determined on chain, at least not now. I've mentioned that the global market is $7.5 trillion daily. The euro to dollar market alone is $2 trillion daily. So the price of euros in dollars is determined off-chain in these interbanking markets, within these institutions or between these institutions that we've mentioned, and in general on global FX desks. These AMMs are not great in mirroring off-chain prices because someone has to actually enter that AMM and rebalance these pools so that they actually correctly represent the current price of euros in dollars, for example. So what we've done differently in our markets is actually, and this existed also on chain before, but in the past actually couldn't be built out very efficiently. It's oracle-driven markets where we query a range of different oracles. Already today we work with Chainlink a lot, and Chainlink has great oracle infrastructure. We also work with Redstone. We work with a few others. We are also now looking into integrating Pyth and other oracle providers so that we can actually, for our markets, that instead of AMM we call FPMM, fixed price market makers, we can query a wide range of oracles about the FX rate, and then allow users to swap directly at this FX rate. These markets, these new type of markets, these FPMMs, these fixed price market makers on Mento, is what we in the end call distribution pools, because they are great markets to basically allow users very efficient access to different currencies on chain. So you can easily access then these 15 currencies. You can easily access, for example, a euro. What we already see today is that a lot of actually users, traders come in and basically use our markets to, for example, source euro every time when on other type of markets, for example, on Uniswap, the price of the euro is not correct because these pools are imbalanced at the current FX rates, and therefore arbitrageurs, for example, use these FPMMs already. What we also need to supply then the stable coins in these FPMMs are in some way then what we call expansion pools, markets where these stable coins are minted into existence. In today's setup of Mento, we have a single reserve. That single reserve is over collateralizing all the stable coins that are outstanding. The reserve is fully on chain so that everyone can verify that this reserve exists. And against this reserve, you then can mint stable coins into existence. We always had the idea to basically hold collateral in many different currencies in this reserve. However, there is not so much local currency collateral in existence today already. So there's not a lot of tokenized Kenyan shilling government bonds and a lot of Philippine peso government bonds. Actually, Philippine peso, there are tokenized government bonds, but they don't exist for every currency in the world. Therefore, basically, this single reserve has in some way holds an FX risk because the collateral mostly is actually dollar collateral. Mostly is actually other dollar stablecoins like USDC, USDT, DAI, and so on. The reserve is over collateralized because it also earns yield. All the yield is flowing back to this reserve. So, for example, instead of DAI, this reserve holds staked DAI. I think it's called SUSD or something. It's not called stake DAI anymore. It also holds, for example, a yield-bearing euro stablecoin and others. But in a future version of Mento V3 that we're now soon auditing and rolling out still this year, we also offer CDPs, in the end built on liquidity V3, CDPs where users then actually can borrow local currency into existence by posting, for example, a dollar stablecoin into a CDP, into a smart contract as collateral. And therefore, Mento, in the end, let's say, has three components. One component is in general as a product, the stablecoin. Then the second component are these CDP type of markets where users can borrow local currency stablecoins into existence. And then the third element is these FPMMs, these fixed price market makers that allow users to swap one currency for the other.
There's a lot to unpack here.
Yes.
And I have many questions. Maybe I'll start with kind of like explaining kind of how I understand this. So kind of like there's one centralized reserve pool, and kind of like I can borrow different assets against it. So kind of like if I want to go from currency A to currency B, kind of what I do is kind of like I clear my debt of currency A against this reserve pool, and then borrow currency B instead. Is that
Yes.
a correct? Okay, cool. That's clear enough. Then you say that kind of you because the main trading venue and the thing that determines the price isn't natively on chain, you rely heavily on price oracles, right?
Yes.
So these are notoriously tricky, right? So kind of if you look at price oracles, often kind of like, especially kind of, I mean, the currency ones, often they usually they don't update kind of like during weekends, for instance, and kind of they don't update often outside of trading hours. So kind of like it's very much a 9 to 5 sort of feed. But obviously kind of like price movements happen outside of these trading hours too, right? So kind of sometimes kind of like you don't have trading for the weekend, and then kind of like the euro US dollar trade is kind of trading is taken up again, and kind of like you have an instant movement of I don't know, 1% or something, right? So how do you deal with the impermanent loss that's kind of incurred by these gaps in your price feed?
Very, very good question. So in the end, these FPMMs try to be more efficient than AMMs by allowing users to exchange at the exchange rate every time when there is an exchange rate update. So basically every time when the Oracle delivers a new price, then these basically markets are set to this price. And in many very liquid currencies, this can happen every second. However, in between seconds, or as you said, for example, outside of trading hours, on weekends, for example, there is no price update. And in these times, basically, these FPMMs basically fall back to AMMs. So basically, they then work completely in the same fashion as a standard AMM, as, for example, Uniswap works when you have like two pools between a euro and a dollar. So every time when there is a price update, these offer more efficient pricing. When there's no price update from an oracle, then they fall back to the AMM solution. And therefore, basically, users cannot exploit the market then on a weekend, for example.
What does this mean in terms of spread? So kind of like if you kind of obviously kind of an FPMM can work much more efficiently than kind of like a regular AMM, because kind of like here you can take advantage of knowledge about market movements and kind of try to extract value. So I mean, the way that kind of pools generally defend against this is by kind of like putting a spread. So kind of like there's, I don't know, 25 basis points spread on fairly liquid markets on weekends. So how do you handle this, particularly for markets that are prone to larger movements?
Yeah, absolutely. And I think this is the important part, that especially during trading hours, when there is Oracle updates, the spread can be much closer together. Basically, we can offer a more efficient price. And then the spread also depends on still a few different things. There's a small fee for the platform. This is in the end next to yield revenue, how Mento as a protocol, as a decentralized protocol is basically being financed in some way. There's a small fee. And then there is an additional spread that depends a bit on A, the volatility of the currency, and then B, on the reliability of these oracles. So we know that then some oracles, for example, for Ghana and Cedi, are less reliable, for example, than oracles for US dollar. Because there's just less trading venues, and basically this can be accounted for in the spread. In general, the resulting overall price of then one stablecoin you purchase for another stablecoin should be a more efficient price than in an AMM. So this is always basically the I would say benchmark.
It's a lower floor, right? Kind of like if
Exactly.
that's kind of like what you default back to.
Yes, exactly. And this is then basically because we're coming from a lower floor, we can offer like more efficient pricing than in these types of markets.
Mm-hmm. Yeah, that makes sense. One thing I was wondering, kind of like who actually uses these, right? So kind of like if you think about it, kind of like it's a purely on-chain representation of the currency. So kind of like it kind of conveys the risks and the benefits of the currency, but you can't spend it anywhere, right? Or you can only spend it on-chain, kind of like with people who accept it. You can't go to kind of like the local Aldi in Ghana and kind of say I want to spend this here, right? So how do you think about connecting it to where most of finance lives, i.e. the legacy rails, in terms of on and off ramps and kind of integrations with IBAN and Visa and so on?
Yeah, is a complex question. I think there's like many different elements here. Is a great question. I think the first element on who uses it today. Currently, I would say in general there are two types of users. What we see currently on Mento, in terms of usage, we currently last month, drive around 100 million in volume a day. This is approximately basically the volume that moves over Mento per day. And we have the majority of users is actually retail users. The majority of volume is actually traders. On the retail user side, these are users that actually in different markets access Mento to optimize, for example, for off-ramping fees or on-ramping fees. So, for example, Mento is directly integrated in MiniPay, a wallet by Opera. In MiniPay, you can have different pockets in different currencies. You, for example, have a USDT pocket and you have a CUSD pocket. And then if in a certain country or on a certain day, either the off-ramping or on-ramping price for Tether, for CUSD, or for Circle, for USDC is cheaper, then basically people just swap into that currency and they access these markets. These are typically relatively small amounts that are being swapped. However, these are a lot of trades and a lot of users that we see there that in the end optimize for basically the off-ramp. Users could also go and use other integrations that are built out locally. There's, for example, a project in Africa called Pretium that, for example, in Kenya and in a few other markets where M-Pesa is big, allow you to basically go from a Kenyan shilling into Kenyan shilling in M-Pesa. So users then could use a Mento to swap from a dollar stablecoin into a Kenyan shilling stablecoin. Then they use Pretium to basically go into M-Pesa, and then often they use M-Pesa to pay at a local store. So here, again, we see a lot of users and smaller amounts that are being swapped. Larger amounts are being traded by what I would say either bots or more professional arbitrage traders that actually then, for example, query the price of dollars, euros, yen, and whatever you have on, for example, Uniswap. And then basically arbitrage between the Mento markets and the Uniswap markets and a few other markets. Here,
but these are value extractors, right? So kind of like, I mean, obviously they provide a service by kind of like updating the price, but they provide that service at the cost of the liquidity providers.
Yes, and in the end, basically at the cost of the liquidity providers in AMMs, for example, where the euro or the dollar or whichever currency is just not represented correctly. Here they basically extract it.
So I'm just kind of like taking issue with the fact that kind of like I wouldn't have called them users in the sense that kind of like they're not looking for the product itself. They're kind of in a way they're kind of like abusing the product.
Yeah, and I mean, depends a bit if it's actually abusing the product or basically accessing currency at the right price to then maybe abuse the fact that on AMMs or on other
Yeah, fair.
marketplaces, the price is actually not represented correctly. So maybe sounds a bit weird, but actually then abusing other type of markets
Yeah.
that are not efficient on chain. I think that is for sure a second user group. Then we also see more and more actually speculators that want to speculate or trade on FX direction, basically on taking directive bets on FX prices. We've seen this less in the past, just because any other crypto asset is more volatile than currencies. So in the past years, users were more excited to, I don't know, leverage up their Bitcoin exposure by factor 10 and trade on this than on trading on FX. But we're seeing more and more actually traders that also want to take directional bets on FX. Here we can, for example, or why are we seeing this? Because every time the volatility of, for example, the dollar spikes up, we also see a spike in trading volume. One interesting incident or two maybe are last November during the election in US, the dollar became more volatile, and then this year during the so-called Liberation Day, where Trump announced random tariffs, or not random, I don't know if they're random or not, tariffs for every country in the world, the dollar became more volatile. This as a neutral statement, the dollar just became more volatile. And on these days, for example, we saw more than $500 million in trading volume just on one day, where users actually went, for example, from dollar stablecoins to euro, to Swiss franc, to Japanese yen, to pound, and so on. Where basically users maybe bet on a loss in value of the dollar against other currencies.
And they do this on chain because the latency is much smaller, right?
Yes,
Okay.
and maybe also because they're actually on-chain traders. And I think this is in some way also a group of users that we neglected a bit in the past by focusing so much on building out like retail product in some way, and also focusing so much on maybe getting traditional FX traders on chain. We neglected a bit that we actually have a lot of traders on chain. There's a lot of, or if there's something going on chain, then it's trading. So we actually have traders already that trade on chain, and here we are offering new types of markets in the end, and basically new trading menus. And this is, I think, still helping the goal of making, for example, currencies more accessible in every country of the world. It still is helping that small business in Kenya that is doing business with, for example, someone else in Ghana, because now we actually make these local currencies more liquid on chain, and we make the overall platform more accessible, and the overall platform, thanks to these arbitrageurs, extractors, traders, and so on, becomes also more liquid. Then actually also these currencies, these local currency stablecoins, become more usable.
Yeah. So I didn't want to. I have no issues with traders in principle. So kind of like, I mean, if you have a hypothesis that the Kenyan shilling is going to go up against the US dollar, you should be able to kind of trade on this. I was just kind of like trying to make the point that some of the order flow, especially kind of like with these more market neutral traders kind of is toxic and kind
Absolutely.
of and hurts the protocol.
Yeah, no, I agree. And I agree. On the other hand, basically what we are trying to offer is basically alternative markets, and with that an alternative to everything that currently exists on chain, because we think FX in general currently on chain cannot work because the necessary infrastructure, and most importantly for me, the necessary basically market infrastructure is not existing. So basically we are trying to offer this to users. And maybe one more item here. So what you actually can do if you want to express an opinion on a currency that, for example, the Kenyan shilling is appreciating or depreciating against the dollar, for example, you can do this actually in two ways. You can actually directly trade on Kenyan shilling and dollar stablecoins, but you could also use these CDPs and borrow one currency into existence against the other. And therefore, you could then, even if you want to, leverage yourself up and do whatever you want. The other thing that I wanted to add is that in the past, I think having access to dollars has been described as the main use case of stablecoins, basically giving people in countries where there's high inflation access to dollar as a huge use case. And I think it's a huge use case. It's certainly true. If you're in a country where the inflation of your local currency is extremely high, it's great that you can get access to a local currency. However, this only is true when you want to save and when you want to hold currency. If you need to borrow, if you need to get a small loan, then it's actually not true. Then if you need to get a small loan to build out your business in Kenya, as an entrepreneur, you actually have the preference for local currency because your revenue is in local currency. And I think also there is an additional use case for local currencies, lending or credit in general, that is huge, because in many countries of the world, this is actually another feature with on-chain technology that we can actually help with, basically making maybe even credit more accessible with this infrastructure. But then it needs to be, for many users of the world, credit in local currency, because revenues are in local currency, and the one who gets the loan shouldn't be exposed to FX risk.
Absolutely, 100%. I mean, could also go your way. So kind of I bought a house and finance it with a CDP on-chain, and kind of obviously that was priced in US dollars, and that's gone tremendously well for me. But yeah, I think, I mean, obviously can also go the other way, right?
Congrats. That's good. I mean, it's speculative, but it worked.
It did work. So maybe let's kind of shift gears a little bit. I kind of want to talk about kind of like the wider stablecoin landscape. So kind of like for the longest time, there were two different approaches, or maybe three different approaches, two used approaches to stables. So kind of there were centralized custodial issuers, so people like Circle and Tether, and then there was crypto collateralized stablecoins, right? So like DAI or SUSD as it's called now. And then kind of there were algorithmic frameworks and kind of like things like Terra Luna and Basis and so on. Maybe let's not talk about them, because kind of like they never had traction in a sustainable way, and kind of like these two kind of turned out to be the ones that that kind of bore the brunt of the sustainable traction. So now with kind of Mento and more recently M0 Labs, kind of we see the rise of something else entirely, which is kind of like a decentralized issuance framework, rather than kind of having kind of like these centralized, in some sense, issuers. How do you see that?
It's a good question. And in general, USDT and USDC are massive and are continuously growing. So currently, at least, it looks like that this is a very successful direction that both of them have taken. And I think their risk profile also changed over the past 8 years. I think a few years ago, there was the risk was just on a different level. I think with their success and with maybe also being a bit lucky that basically interest rates went in the direction where interest rates went to, they now are like more sustainable in their overall setup. I think that changed over the past years.
And they are more sustainable because kind of like they reap those rewards, kind of like that's their business model, right? Kind of like they hold trillions of funds or billions of funds in custody and kind of get 3.5% on T-bills or whatever, kind of like they kind of turn the money into, right?
Exactly. And that mostly works when interest rates are positive. That works. Maybe also one of the reasons why there are less euro stablecoins, because actually the interest rates have been negative for longer in Europe compared to the US. Could be one of the reasons. And then actually also sometimes, for example, with USDC, there was that problem when Silicon Valley Bank went sideways, where users were not really sure how much of the collateral actually was held with Silicon Valley Bank, where then actually that credit risk we talked about before materialized and USDC depacked. And I think there's certainly a use case that for these stablecoins, they are very successful. I think there's also not every part of the tech stack in general has to be fully decentralized. And USDC, USDT are certainly not decentralized, but there's a use case for them, and therefore, basically, I think it's good that they in general exist. With other models, I think what we're now actually offering is giving users more choice, and that users have more choice can come from either different users have different preferences, but it could also mean different users just want to do different things. So for example, if you want to get a loan in Kenyan shilling, or if you want to exchange from Kenyan shilling to Ghana and Cedi, you cannot use USDT, and therefore it's good that these new types of stablecoins also in local currencies exist, like a Kenyan shilling stablecoin or a Ghana and Cedi stablecoin. In general, in the longer run, we don't want to differentiate too much, because we think, and here we've seen a lot of research actually in the past, that these new types of stablecoins could be in some way a race to the bottom, that like to grow actually market share, a stablecoin issuer now has to forward either all of the yield that they earn on collateral or even more than they earn on collateral to actually gain market share. And then many of these stablecoins increased in circulation while there were a lot of incentives, and then they decreased again when the incentives were running out. I think in general for Mento, the larger business model is actually in offering proper swaps and proper FX infrastructure between these different stablecoins. And therefore, we are also integrating other stablecoins as well. I've mentioned that we already in Mento markets have integrated USDC and USDT, and in future will also integrate other stablecoins. I think there's also a regulatory element to it. There will be different regulation in probably most of the regions of the world. There is now MiCA in place, and there's this Genius Act in US. There's some regulation also in Singapore, and I think in Hong Kong something is coming up. There's regulation also in the Philippines, but there's also no regulation in many other places of the world. So I think also from a regulatory perspective, we'll see different offerings. Maybe there are countries where actually a stablecoin looks more like a CBDC, and there are countries like the US or also areas like Europe where stablecoins can actually also be issued by other issuers. And then depending on the use case, users probably also have different preferences for different stablecoins. So in general, what I want to say, a bit complicated, is there will always be many different stablecoins. I think what we want to do is we want to offer proper infrastructure for these stablecoins, and we want to make sure that there is a stablecoin for every country in the world that users can actually access local currency. But I think it also makes sense to have regulation like, for example, MiCA, where if you are a fully centralized issuer, if this really looks like a bank, your business, then maybe it should also be regulated like a bank. Or if it looks like an ETF, maybe it should be regulated similar to an ETF. If it's fully decentralized, then you should also make sure that actually the information, the data, the collateral, and so on are all very accessible and transparent. And I think that makes sense. And therefore, it's maybe good that there's so much competition between different stablecoin issuers.
How do you handle the governance in Mento? Say, for instance, I want to induce you to kind of list a new currency you don't have. So, say the Namibian dollar. How would I go about this? Kind of like, whom do I need to convince, and what are the measures I kind of like need in place for this to happen?
Yes, and in the end, this, of course, on the one hand, is nice because everyone can participate in a protocol like that. But on the other hand, also makes it really, really complicated. So with Mento, governance is on chain. There's a governance token, the Mento token. And with this, users can decide, for example, which new currencies to launch. Users can also decide which new ecosystems to launch on. And users can also decide, for example, about fees, not only what we do with the fees that come into the platform, but also how high the fees should be for different pairs. I think this is on the one hand nice because it actually makes it decentralized and gives basically control to users. On the other hand, it comes with all of the problems that also have been discussed in this podcast and others before that come with decentralized governance, because in the end, it's always hard to find educated governance participants that are willing to spend some time to read into proposals. So we try to put out from Mento Labs a lot of like research and try to put out a lot of information on how in general Mento works, make this all very transparent. But I think in general, this is something that can only be improved, where basically we can educate users even more of basically what are the implications of adding more currencies, what are the implications of certain fees, and so on. I think sometimes here governance gets it right and sometimes it doesn't. And in general, it's all of it is on-chain governance, but it doesn't really make our life easier.
Yeah, I see that. I have one more thing I'd really like to talk about, and that's kind of MetaMask recently came out kind of with its announcement that they will launch their own stable coin built on M0 infrastructure. Can you walk us through how M0's approach differs from Mento's?
So in general, basically M0 has a focus on dollars. So I think the very short answer is we have a focus on the FX part and local currencies. I think what M0 is doing is basically giving a standardized basically platform to launch different dollar-based stablecoin is certainly valuable. I think it's really, really important because with that we again standardize a part of the technology stack. And I think for the dollar it also makes sense because most of the stablecoins out there are actually dollar-based stablecoin. In terms of Mento, we focus a bit more on the local currencies. So we focus on basically actually having the different oracles to exotic and less exotic currencies. We focus on basically having these markets where also M0 stablecoins can be integrated and can allow users then to swap at the FX rate. So I think here this is the FX part is the key difference.
Are you looking to kind of integrate more directly with banking and payment systems? So kind of offering, for instance, your Ghanaian users kind of the use of Mento stablecoins natively from their banking application?
Yeah, I think in general, we want to integrate Mento where users swap between different currencies. So for example, if you today already use Squid Router to swap from one currency to another, then Squid Router calls the Mento functions to swap between different currencies. And if you actually want to swap into a currency where currently there's no supply, then Squid Router actually also calls that minting function of Mento, where basically local currencies are minted into existence. So we want to integrate in routers, we want to integrate in wallets, we want to integrate in like everywhere where users basically want to swap from one currency to the other. I mentioned this pockets feature of MiniPay by Opera before. I think this is also interesting because users want to swap to basically get the cheapest off ramp and want to use Mento. So in the end, everywhere where users want to swap between different currencies. And I think first, what we're now actually focusing on is bringing Mento cross-chain onto other ecosystems, so that basically this then also becomes accessible on more chains than just Celo. And then second, we want to also roll this out in different venues in the end.
Super cool. Where do we send listeners who want to get involved, so kind of contributing to Mento, whether as developers, community members, users?
So I think one landing page is, of course, the web page, mento.org, and users can basically there find also the GitHub, the blog, the docs page, docs.mento.org, the white paper, and so on. Then there's, of course, also X or Twitter, the Mento Labs account, where we basically want to keep everyone informed on everything that is new around Mento. And in general, also, I think the team is always happy to talk to users, to talk to builders. We're large part of the team is actually based in Berlin, so we are always happy for users that want to build on top. I think especially when it comes to building for FX, there's a lot that is completely untapped in Web3. I mean, we now actually offering swaps, basically, where you can go from one currency to the other. There is also futures, there's hedging platforms, there's so much more, there's options, things you can actually build on top. So we really want to excite more builders also to use basically that Mento functionality.
Super cool. Thank you so much for coming on, Markus.
Absolutely. Thank you so much for having me. And I really enjoyed the conversation.
Thank you.